Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the best moving average strategy that can help you consistently deliver results for professional traders. The moving average are powerful technical tools that can help you identify trends, spot reversals, and find optimal entries and exit points. So by the end of this video, you would understand exactly how to implement this strategy in your own trading potential, transforming your approach to the market, whether you are struggling with timing your entries or finding yourself on the wrong side of trade. This strategy will provide you with a structured framework to make it more informed in your decision making. So stay with me until the end to discover how to combine specific moving averages that can give you a significant edge in the market. We start by understanding what moving average are, and they are powerful technical indicators that smoothen out price fluctuation, helping you to distinguish between market noise and actual trends. There are two types of moving average, and they are the simple moving average and the exponential moving average. The simple moving average calculates arithmetic means of price over a set period of time, while the EMA or the exponential moving average helps you to give more weight to the recent price, making it more responsive to new information. So let's look at the best moving average trading strategy. Since we understand what moving average is about, we have to spot we have to use our 15 minutes time frame. So we first set up our chart by using our 15 minutes time frame to get an idea of this strategy by combining multiple time frames to capture trends while minimizing false signal. So when we use our 15 minutes time frame, while using our 15 minutes time frame, we plot three exponential moving averages on the chart. The first exponential moving average we would use is the 5 moving average. The 5, which is the fast moving average. We use a length of 5, and the second EMA we would use will be a length of 20. This is basically what we use. We use length of 5 for the fast moving AMA. We also use a length of 20 period EMA for a medium range. We add one more EMA to our chart. Adding one more EMA to our chart, we will put the slow moving EMA to 50 moving average. We put it to 50 moving average. This will help us better understand what we are talking about, and we'll change the color of the 50 so that we don't contradict ourselves. We change the EMA to red. This will better help us understand the longer period is the red line, the medium line, which is the 20 period moving average, is the yellow, while the blue line is the fast moving EMA, which is the 5 period moving average. These three EMA will help you to identify short term and medium term and long term trends respectively. So we identify buying signals. To spot potential buying opportunities, you follow these steps. First of all, you wait for your 5 period EMA to cross below the 20 period EMA. To cross above the 20 period EMA, you wait for your fast moving EMA, which is this blue line, to cross above the 20 period EMA, which is this yellow line. When price cross above, this signals buying opportunity. You ensure that the price is above the 5 period moving average and the 20 period moving average, and also the 50 period moving average. When price is above this, it all aligns with your trade. This alignment indicates a strong bullish trend across multiple time frame, increasing the probability of your trade setup. While to look for a bearish trading setup, all you need to do is look for the 5 period moving average. Let's look for a bearish trading setup to understand how to implement it. Now we would wait for the 5 period EMA, which is this blue line, to cross below the yellow line and the red line. When it cross below both the 20 period and the 50 period EMA, this confirms that we are in a downtrend. And remember that price has to be trading below both the 20 EMA, the 50 EMA and the 20 EMA. In this area, this confirms our selling, our strong bearish trend, providing opportunities to sell. So when we enter in such position, when we see the alignment and the crossover, we can enter when price comes back to retest the EMA, the fast moving EMA, which is the 5 moving EMA, or the slow moving EMA, or the medium moving EMA. When price comes to retest, we enter our trade and we set our stop loss. We set our stop loss for a sell trade. We set it above the 20 period moving average. We set it above the 20 period moving average, which is this yellow line. You set your stop loss above the moving average. While in a buy trade, this our buy trade we were meant to take in this area. When we enter when price is above the 20 period moving average and the 50 period moving average, when price comes back to retest, we enter and we put our stop loss just below the 20 moving average, the 20 period moving average. This is where we place our stop loss. We can also use a fixed stop loss of 40 pips or 45 pips from your entry. This approach helps you to protect your capital while giving you a trade room to breathe, giving your trade room to breathe. We also need to manage our trade. Once you are in a trade, proper management is key. Consider moving your stop loss to break even once the trade is in profit. So the moment our trade is moving in profit, we can decide to bring our stop loss and add it to break even slightly above our entry period to accommodate for our spread and our swap fees. So this is how we can protect and manage our trade. We can also use a trailing stop to take profit based on key support and resistance level. You can use a trailing stop. This approach allows you to protect your profit while letting winners run. So while you are protecting your profit, you can assume, let's assume this is our take profit, this is our stop loss. So I would change this stop loss to red so that it will not complicate things. Assuming this line is our stop loss, we take it from where it was and put it above price. As price keep gaining in our favor, we adjust our stop loss, based on what price is going. The more price comes to the upside, the more we put our stop loss above, securing profits as we go, so that if price comes back to your stop loss, it will take out your stop loss and you will be in profit. We can also decide to confirm using other indicators to increase the reliability of your signal. Consider combining this with other momentum indicators such as your MACD. You can make use of your MACD indicator while making use of this strategy. This multi-indicator approach can help you filter out false signals, and as we can see in this area, the histogram of the MACD is in the bullish area, and at the same time there was a crossover for the MACD when price decided to move to the upside between the MACD line and the signal line, which indicates strong bullish pressure. This further simplifies our entry and confirms that we are in the right direction of the market. We have to always look for, in a bullish scenario, we look for an increasing bar in the direction of your trade. So since we are looking for buy trades, our bars, our MACD histogram is showing an increased bar. If we go to our selling opportunity, we'll look for the same reason, and as we can see, the MACD indicator signifies an increasing bearish histogram. When we enter the bearish trade, we can see the bearish histogram is increasing as we enter the trade, and we can also spot a crossover between the MACD line and the signal line. This helps us to further get confidence in our trade setup. So we have some advanced moving average strategies. For experienced trader, you can consider exploring the Gumpy multi-moving average system. You can use the multi-Gumpy moving average system in this trading strategy. So when we want to use this, we will just simply indicate by using our moving average ribbon. We use our moving average ribbon to understand this, and this is making our chart a bit complicated, but if we understand these levels on the chart, the moving average ribbon, it helps us to know when the trend will be in a longer direction and when the trend will be in a lower direction. This comprehensive view of market structure can provide deeper insight into the trend, strength, and potential reversals. Each effect approaches is the 5813 simple moving average ribbon. So this is the lines. Let me turn off other indicators to just use the moving average ribbon, and this is the ribbon. We just expect price to get to these areas to tell us that we can leave, or we are expecting a momentum shift when price gets to this area. These lines also confirm trends, and they used Fibonacci driven numbers for their combination. It is particularly useful for day traders as a tool to highlight momentum shift, check trends, and help assess risks in the market. So basically, when price is below these ribbons, it signifies that we are in a downtrend, and when price trades above these moving average ribbons, it means we are in an uptrend. Remember, no strategy is foolproof. Always use proper risk management and adapt your strategy to your trading style and your market condition. With practice and discipline, this moving average strategy can become a powerful tool in your forex trading arsenal. Alright traders, we have come to the end of this video. Please engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe, and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.